Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. Everyone likes a nice story. It's true in movies, it's true in boardrooms, and it's very true in financial markets. We like to think investors are purely analytical, rational, objective, and only guided by data. But below all of that, they're still human. They look for coherence, of course, and they want to believe that the numbers fit into some larger pattern, something that makes sense of uncertainty. And that pattern almost always takes the form of a story. So today, let's talk about stories. Neuroscientists have shown that when we listen to a story, our brain activity synchronizes with the storytellers, a kind of emotional connection that makes information stick. The same thing happens in markets every day. In earnings calls, roadshows, IPO pitches, they all rely on narrative to make complexity digestible, right? But in finance, stories aren't entertainment because they carry an extra layer of risk. They move capital. And that's why a persuasive narrative can add billions to a company's value, while a weak one can erase just as much. Damodaran, who's become something of a philosopher in valuation, says that valuation is a bridge between stories and numbers. Every forecast, revenue, margin, return begins as a story about what might happen. And every number in a financial model is just a story translated into math. But the challenge begins when the story runs faster than the data can keep up. And markets are full of what he calls runaway narratives, which are stories so compelling that investors stop checking the math. Remember the late 1990s dot-coms, the early clean tech boom, and cryptocurrency. NMC Health, if you recall episode 9, of course. All were powered by stories that promised transformation but ignored risks. The point isn't that stories are bad, it's that they need discipline. Numbers give stories structure, and stories give numbers meaning and direction. And one without the other is incomplete. Investors who rely only on numbers miss the big picture, and storytellers who ignore the numbers lose credibility. Ironically, the more data investors have, the more they depend on story. And Damodaran calls that the paradox of the data age, because our attention shrinks as information explodes. So we become desperate for a clear narrative that turns raw data into something the human mind can actually digest. So investors aren't allergic to storytelling at all. They just need it told in a way that respects their intelligence. They can process complexity, but they won't tolerate manipulation. And that's why structure matters. Barbara Minto's pyramid principle, for example, is one of the clearest frameworks for structured communication. It started as a McKinsey manual, but its logic fits investor communication perfectly. The principle is simple. You start with the answer, the big idea, then you support the big idea with a few key ideas, and then you support each idea with clear evidence. It's how the human mind naturally prefers to absorb information, top down. And the same logic applies to how companies should communicate, in my opinion. You begin with a strategic thesis. Here's what we're building and why it matters, and then you layer in the reasoning. These are the drivers, the sources of competitive advantage, the risks. And only after that do you show the evidence, the metrics, the proof points, the benchmarks. Because that sequence gives investors information in the way the human mind likes to receive it and digest it. Investors, consciously or not, think in pyramids too when they evaluate a company. They start with the headline, the central story, and then they test for supporting logic, strategy, market, execution, risk, and they finally test for evidence in the numbers. When your narrative structure mirrors that cognitive sequence, they don't have to guess what you mean. They just get it. Researchers call this balance between words and numbers CNR, and that's short for corporate narrative reporting. Financial statements show you what happened, not why. The narrative sections, on the other hand, the chairman's letter, the strategy overview, and the risk disclosures, they explain why. And when that integration works, it helps investors move between data and narrative until both make sense. But when it doesn't, it becomes just another medium for corporate speak, mostly intended to manage risk instead of actually clarify. And the evidence is strong, according to the research. The research examined over 31,000 firm-year observations across 63 countries from 2003 until 2019. And it found that forward-looking, specific, readable narrative reporting is correlated with higher valuations. In other words, investors reward management teams that talk clearly about the future and that identify risks openly and that link non-financial initiatives to financial outcomes. If you think about it, markets themselves are storytelling machines. Share price is just a collective story about value. Earnings calls, board meetings, they're all ways for updating the story with new evidence. Even accounting standards are a form of narrative discipline. It's a shared language that keeps everyone telling stories within the same grammar. And stories evolve to help humans coordinate and to align on what's real and what matters, and the same applies in capital markets. A credible story allows thousands of investors to coordinate around a shared expectation of the future. Of course, every story has tension because if it didn't, no one would listen. The tension in corporate storytelling is between aspiration and, let's say, accountability. And the best communicators integrate both. They talk about vision, but they also talk about risk, and they acknowledge uncertainty instead of hiding it. They connect big claims to measurable outcomes, unit economics, cost curves, margins, cash conversion. They simply invite the audience to test the story against the evidence. And like novels, corporate stories evolve through acts. In Act 1, for example, the startup phase, the story is about what's possible. In Act 2, the growth phase, it becomes about execution. In Act 3, the maturity phase, it's mostly about resilience. And in Act 4, the decline phase, it's probably about decline or reinvention. The danger is when the storyteller forgets which act they're in, and a mature company that keeps narrating Act 1 sounds delusional because it's already mature. A young company that talks like it's in Act 3 will probably sound on the conservative side. The ones that last are those that keep revisiting their story as they learn, and that narrative credibility over time becomes an intangible asset. But because storytelling works through emotion, that very reason makes it a huge responsibility. Because stories bypass our rational filters, as the researchers show. They make us feel first and think later. And that's exactly why financial storytellers must be extra careful, because a narrative that manipulates belief without evidence may produce favorable outcomes in the short term, but they will most certainly hurt the company in the long term. In markets like ours, the need for credible storytelling is crucial because we're in a phase of transition. Economies are diversifying, new sectors are being born, capital markets maturing fast. But the informational gap, the informational distance between companies and investors remain wide. We do have powerful top-down narratives, but what's missing is the middle layer. How individual companies translate those big ideas into coherent and evidence-backed business stories. If you ask me, this is where narrative discipline becomes both a differentiator and a moral obligation. What makes a nice story in markets isn't the gloss or the polish, it's the balance. It's a CEO who can talk about ambition and risk in the same breath, and a CFO who can link strategic objectives with financial targets in the same sentence. Because stories give investors context, a sense of purpose behind all that performance, and numbers keep those stories grounded in reality. Because markets exist somewhere between what companies aspire to and what they can actually measure. Everyone likes a nice story, but in my very humble opinion, the ones that last are the ones that evolve with new evidence and the ones that stay honest. Next time I'll talk about purpose and how the search for meaning in business isn't so different from the search for meaning in ourselves. I am Zein and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.